I think not right away, but I do think that we are kind of entering the next global liquidity cycle. So I think the kind of the relative monetary austerity of 2022, 2023 is kind of behind us. And now we see, we're back to money supply growth in the US and elsewhere. Um, and, I think that I mean, what's interesting is that this cut was the first one in a while that the market wasn't sure about. Usually, the Fed telegraphs very clearly what they're going to do, and going into that day, the market's nearly 100% sure what they're going to do. This one, the market, even in the couple days before, it was kind of 50-50 on whether or not it'd be 25 or 50 basis points. They went with a more dovish approach. Um, the way they would frame it is one, unemployment. They don't want it to get any softer. The way they measure it, they don't really want that to worsen. And two, they would argue that even if they if they hold rates flat, but official measures of inflation decrease, then they're actually getting more hawkish over time because their real rates would be increasing. So let's say inflation's 5% and rates are 5%. If inflation falls to 3%, while they hold rates at 5%, they would argue that they're kind of gradually getting hawkish over time, even just by doing nothing. And so their approach is say, well, if we cut 25 or 50 basis points, we're still being like not accommodative. It's just that there's a lower level that we're being hawkish from. That's I think how they would describe it. Um, and I think overall that one of the challenges of fiscal dominance is, if you look at, there are periods of monetary dominance. So for example, the 70s was a period of very rapid bank lending. The baby boomers were entering their home buying years. There's faster than normal bank lending happening. That's where most of the money creation was coming from. And public debt to GDP was only like 30%. And so if you raise rates super high, you can slow down that bank lending more quickly than you increase your interest expense that pours out into the economy. The problem is that in this cycle, because we're in fiscal dominance, we have 120% debt to GDP. Bank lending was not the problem this time. Bank lending is average in the United States. It's not particularly fast. And raising rates does slow down that bank lending a little bit, but it wasn't the problem in the first place. And it actually increases the deficits, which are actually the source of inflation. So interest rates don't have that quite as clear relationship with controlling inflation as we associate them with back in the 70s and 80s. And so that's part of the reason I expect these deficits to be structural, is that the Fed's kind of stuck in a no-win situation where if they keep rates high, it means the deficit keeps blowing out even more, which eventually can be inflationary again. And if they cut rates, then they can weaken the dollar. They can emerging markets can get a little bit of a boom because their dollar-denominated debt weakens. They can increase their energy consumption and other things like that, and then you can get more inflationary pressures. And so either way, this is, I think, a background issue that they're going to deal with for years. I think that they're going to keep money printing, mainly to save the Treasury market. So I'm not sure we'll see the fast rate of QE that we've seen in an effort to stimulate the economy. But basically, I think that whenever the Treasury market becomes illiquid, they will basically go back to supporting it. So for example, the last time quantitative tightening ended was September 2019. They had been reducing their balance sheet. Eventually, the repo rate spiked, and everybody was focused on the repo rate, but there were some analysts, such as myself back then, saying it's actually a T-bill oversupply problem, and that they're actually, right now they started responding with repo support, but then they're going to start buying T-bills soon. And then by the time we got to October, the Fed said, actually, we have to buy some T-bills. We're going to go back to buying T-bills, but we're not going to call it QE. I think we're probably going to see something like that by late 2025. There's different variables that they could push it a little bit, but I think essentially we go back to they're gonna call it basically bank reserves. They want to maintain ample bank reserves, and so basically when the reverse repo facility is mostly drained and all this debt's still pouring out, I do think the Fed's going to go back to kind of gradually increasing the base money supply by gradually increasing treasuries. And if you look at the New York Fed's projection, they already project this, but that by about 2025, they'll have a pivot where they go back to balance sheet increases. One difference that they do plan to do is they don't want to keep supporting the mortgage market. So they plan on letting the mortgage-backed securities keep maturing off their balance sheet while they do go back to treasury accumulation. So I do think that they're probably going to simplify their balance sheet, but not shrink their balance sheet beyond roughly a year and a half from now. Well, so we went through a period of somewhat slower economic growth and very high fiscal deficits, but also pretty tight monetary policy. And so you get a divergence between sectors depending on if they're on the receiving side of deficits or they're on the punished side of high interest rates. So if someone is say operating commercial real estate, they're being impacted by the high interest rates, but they're not really benefiting from the deficit. Whereas if someone works in healthcare or travel and leisure that a lot of retirees are going to and using those services, especially coming out of the kind of the pent-up demand of the lockdown periods. Those areas were doing fine. And tech was an area where a lot of tech companies, especially in this rally, it was not like the ARC type tech. It wasn't like the unprofitable tech. It was the profitable tech companies. And so a lot of them have more cash than debt. And the debt they do have is locked in with very low interest rates, fixed rate. And so every time the Fed increases interest rates, Google got a raise. Google just, their big cash position would get a raise, and their debt is fixed and little compared to their cash. So they were on the right side of interest rate increases. And so basically, there's been like this almost unintuitively like a risk-off rally, which is everybody said, I don't want to hold banks, I don't want to hold energy, I don't want to hold cyclicals, I want to hold tech, big monopoly like tech stocks, as well as other stocks like Costco. Costco is trading at like over 50 times earnings. And people said, well, I want to own that because it's bulletproof. I want to own Costco. So all the money's kind of piled into these kind of mega cap, low earnings volatility types of names, as well as an AI enthusiasm on top of that for companies like NVIDIA. And I think that got overdone. I think we've seen some rotation out of that. I think there's a lot of profit taking, which I think makes sense. These things tend to go through capex cycles and get overdone for a period of time. One of the challenges with NVIDIA is that they're making a lot of money, but all the companies buying GPUs are not really profitable yet. Like they're providing services and losing money, trying to figure out what their business model is going to be in this pretty rapidly evolving period. So I think that we could go through a period of consolidation where people have to kind of say, well, wait, should we be buying this many GPUs, or are we gonna have to increase the cost of our services, which might slow down the demand for those services in order to try to break even a little bit better. And I think one of the more interesting beneficiaries of the cycle could be emerging markets. Generally speaking, any sort of Fed rate cutting cycle is a window where they can do pretty well. The 2019 cycle was the last time there was Fed cuts from a recent high, but that was obviously heavily disrupted by the pandemic, the lockdowns, the less travel happening, energy disruptions, and so that didn't really rotate in the way that it potentially could have. But I think this cycle has a better chance of doing that rotation, where some capital gets out of the U.S. and goes to some of these beaten down and expensive emerging markets that have dollar-denominated debt at a time when the Fed is cutting interest rates and therefore easing the dollar. The short answer is I don't know, but I have a couple sub answers there. One is that by some indicators we had a recession in 2022. So again, like I mentioned before, Misery Index, which is unemployment plus inflation, that hit recession levels. Consumer sentiment hit record lows in the U.S. If you look at bank senior loan officer surveys, whenever they have a really fast tightening in their lending standards, that's historically been associated with a recession. And they had one of those throughout 2022, which is now easing. They're coming out of that, and so by kind of if you take out the fiscal deficits for a second and say what if you look at the private sector and look at the bank credit cycle, there were some recessionary variables there where it didn't show up as unemployment, and it didn't show up in real GDP. And I would say a lot of that's because we had post lockdown just changes in the economy, plus that fiscal dominance that we're in, which changes things. When we look at 2025, the question is unemployment going to keep rising? Historically, when it goes from 3.4% to 4.2%, when it has a move like that, it more often than not, it keeps going for a period of time. And that's the big concern that people have, because if you get that unemployment cycle, then people buy less, and then other companies lay people off, and you get that kind of vicious cycle. I don't know yet, admittedly, whether or not we're going to get that, but my base case would be that even if we get that, I do expect that the unemployment cycle will probably be less extreme than other recessions that we're used to. So I don't think it would be like 2020. I don't think it'd be like 2008. I think it'd be more like the 2001 recession, which was, it was by most indicators, it was not as severe as like the two recessions that came before it or the two recessions that came after it. The unemployment cycle, the real GDP, like year of year change. Um, so I think that recessions look a little bit different when you're in fiscal dominance, which my base case would be less disinflationary than we normally think of recessions, but also potentially a little bit less credit cycle focused and a little bit less unemployment focused, even if we do get that recession. So 2000 had higher valuations in most metrics, not all metrics, than we have right now. Um, I think partially that will depend on what global capital wants to do. If global capital, which is currently really stuffed into the U.S. market, wants to leave, then you could get that more significant bear market. Also,
Mm-hmm.
back in 2001 and 2, we didn't have fiscal dominance back then. If anything, we basically had a surplus. We were coming out of a surplus. Um, and so I think that the background is kind of like we're almost pre-stimulating before we would even go into a recession,
Mm-hmm.
which I think impacts that recession some. But also, right now when I compare equities to bonds, like let's say 10-year treasuries, um, it's not like I really want to pile out of equities and into treasuries. It's just not, neither of them are maybe super attractive. And so instead, there's some assets that are more interesting, I think, but not really the biggest assets. Um, and so I think that's the trouble that the market goes to. My base case would be less of a market decline than the post-dot-com bubble decline, but one that instead could be more just drawn out. You could have a sideways choppy market for years, that especially in real terms just doesn't do very well. If you look at, again, if you look at that emerging market recession analog, often you'll say, well, what are equity prices doing in local currency terms? They're going up. Well, what are they doing in dollar or gold terms? Usually going down. And if it's the dollar itself going through a similar situation, I think, for example, equities probably underperform gold over the next 3 to 5 years. Or at least even if they do outperform, I don't think it'd be by much. Basically, I think that just there's already evidence that equities are rolling over in gold terms. So we'll see how much legs that has to it. But um, I think that nominally, they my guess would be not great returns and chop along and just kind of be uninteresting. And that depends on what sector you're in.